to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode features a different topic and a guest who shares their experience and knowledge with us. Tune in and learn something new with BankTalk podcast.
And welcome to Bank Talk. I'm Charlie Kelly, your host and partner at Remedy Consulting. Today we're talking to Kip Weissman from Luce Gorman. About this time every year, we try to do an episode on merger and acquisition activity in the community bank space. I asked Kip to pull together some material on just, what did 2024 look like? And then, what is he expecting for 2025? And then I thought we'd have some conversation on, headwinds, tailwinds, sort of what's driving activity, what's slowing it down, that type of thing. So without further ado, let's get to Kip Weissman from Luce Gorman. So welcome back to Bank Talk. Kip, I appreciate you joining me today.
Thanks, Charlie.
We're going to talk some merger and acquisition today. So I thought what we'd do is start with sort of what the last few years look like, specifically 2024, and then maybe lead into 2025 and, have that conversation. Would you be okay just kind of giving me trends? Like, what does this look like? What does M&A activity in the community bank space look like over the last several years?
Well, it is a great topic. Thanks for the invitation. It's a great topic and timely topic because we are on a big upswing right now. Since, say, 2019, 2020, there's been peaks and valleys along with the rest of the economy and really culture. Well, COVID was a shock to banks, and there's a little boomlet coming out of COVID because banks weren't sure what the future was. And then, of course, a year and a half later, rates hit. And that we probably should spend a little time on that, but that really put the brakes on M&A activity. And now we're coming out of that. And at the same time, the election has created a lot of optimism and we're accelerating quickly. And we have some exact numbers, but I don't know if they really tell the story. But maybe a better story is a investment banker was trying to talk a client into a transaction by saying, I'm used to tomahawk steaks, but now I'm in skirt steak. And, the client was doing a little violin on that one, but I think they're getting ready to eat tomahawk steak again because for some reasons we can get into, there's a lot more activity, a lot of discussions. We just announced a large $1 billion deal yesterday, I think it was. So $1 billion deal, market values, there's a lot of activity.
Okay. And so run me through, I know COVID threw a big hump in this, but give me the last couple of years, 2022, 3, 4. Are these numbers going up or down?
Yeah. So here's the numbers. Announced transactions. So it takes 6 months to finish them, sometimes more. 2020 was 112. One was 156, 50% higher. That was probably COVID driven. 99. That was interest rate driven. 24 year to date, 115. However, in the next few months, you are going to see a lot. And 2024 omits, it's probably from roughly December 1st. So we are on an upswing, a meaningful upswing now. And do you want to talk about some of the factors?
Yes. I think there was a side note here, and because at one point you and I were going to spend a little bit of time around credit unions buying banks. So any activity there that you can speak to, or do you have numbers there that we can kind of?
That's a piece of this. Yeah, credit unions have gone from, I think the first deal was in 16, maybe. Okay. First time credit union bought a bank. This excludes credit union transactions, which happen a lot. I think until around 2020, there was low single digits. 2020, it started to accelerate. And so far, there's been 20 announced transactions in 24, which is approaching 20% of the total, 15 to 20% of the total number of deals. They're a little smaller, but they're active.
I guess when you think about that, I know we're going to spend a little bit of time here on sort of headwinds, tailwinds. But
right.
I guess that's a good number if you're a seller. There's always this debate about should credit unions be buying banks and taxes, et cetera, right? But if you're a seller, I would imagine the fact that 15, 20% of them are credit unions and maybe they weren't the year before might be helpful to drive rates up as far as purchase price.
Right. And let's think about this. There's a number of reasons for the kind of slow activity the last couple of years. One of the biggest ones was the value of buyer currency. In other words, if you're doing a stock for stock transaction, you're a bank, what is the value of the bank stock? Community bank stocks are up something like 25 to 30% since June.
Right.
So that means they can pay 30% more. Credit unions, by definition, are cash buyers. So cash is cash. So if you're considering a community bank buyer versus a credit union buyer, when the community bank stock is lower and they're going to likely use stock, their ability to pay is 30% lower. Suddenly, it's higher. So you may, from that standpoint, they may get a little more active, at least a little more competitive price-wise. Another factor is in the high interest rate environment, this is very important. In acquisition, a buyer has to look at the value of the company, has to mark to market the target company in using what's called purchase accounting. So in a higher interest rate environment, the mark-to-market value of a target bank is much lower. A credit union is a mutual. So we can take the long view and say that, if I'm buying this $200 million bank, even though the mark-to-market on it is not very great now, over time, it's going to come back and I have time. Bank buyers are generally stock institutions, almost always stock institutions. And they have a little bit shorter term outlook because they got to satisfy their stockholders. And if you're paying $30 million for a bank that's only worth $15 million on a mark-to-market basis, you're going to take an immediate hit to your capital of $15 million, which is just unacceptable dilution. So since rates are starting to go back down and spreads are improving, it makes the mark-to-market better. And that's a really important factor.
Okay. So I'm not entirely sure that I understand that piece of it, but is that due
Neither
to
do I.
unrealized losses? I mean, is unrealized loss a factor as part of that, or
unrealized losses are
okay.
And also just the value, because it's mainly on the asset size. So take a $200 million bank with 20 million in capital. The securities are probably marked to market, but the loans aren't. And these smaller banks have a lot of residential loans, for instance.
Okay.
And the average rate on those might be something like 4%. As you know,
I see. Yeah.
They can lower. So the market value of those is going to be significantly lower. You mark them to markets.
Okay.
$20 million
losses on the security side, but they still also have to look at what are they lent out at and how long are the loan terms and how long before they turn that into a 7%, I suppose, or something along those lines, right?
But that's coming back for a lot of reasons. Rates are one factor, but another factor is simply the blended rate moves up as you originate more loans. Sure. So the credit unions have and they're very competitive. A couple of the headwinds that have been driving this for credit unions could be ameliorating a little. We'll see.
Gotcha. Okay. So on the credit union side, and because they're a mutual, on the credit union side, why is it, I guess in their scenario, it doesn't matter quite as much, hey? As far as they're not the stockholders aren't looking over their shoulders all the time, right? And trying to determine if they paid the right price.
Correct.
And
that would apply to other mutuals as well. And another way to say that is to take a longer view. In other words, our overall goals, we want to hit overall financial and non-financial goals over a 5+ year period. Stock bank may not have that luxury. Okay. And then it's about earn backs, et cetera. That's sometimes made, and the credit unions are a little less experienced. So sometimes maybe there's an overpay. And if you're a target, you love overpays.
Sure.
That's great. They're also, credit unions are a little less aggressive in cutting expenses, which means people. And from a target standpoint, that's not a bad thing either. Okay. So now credit unions have to pay more than banks in almost every case anyway, because their transactions are taxable at the corporate level. So right now, corporate taxes at the federal level alone are 21. If say you're a bank, a bank offers to pay $20 million for another bank. If a credit union a transaction is structured as a purchase, not a merger, okay, and an asset purchase, because a credit union can't merge with a bank in general. A few states they can, but most states they can't. So they're going to have to pay to be competitive with the bank. They're going to have to pay $20 million plus the tax that the bank's going to have to pay on the sale of assets. For instance, they might have real estate that's written down, and whatever gains in the portfolio, that's going to be a couple $1 million. It's all estimated. Plus, credit union transactions take a little longer, so you got to maybe pay a little more. But I can think of another number of scenarios where I had one in Michigan where the credit union bid what turned out to be around $48 a share, and the highest bank was 19. So
Really?
who cares? Yeah. So you just never know. But and they're definitely less disciplined from a financial standpoint, or you could say they take the long view.
Yeah. Gotcha. Let's look at one other factor, fintechs. We kind of talked
Correct.
about, right? I know at least of a couple of fintech acquisitions of banks, trying to get their charter to continue to do business as a bank, for lack of a better way to put that. Is that activity? I would assume that push prices up as well if you have new bidders. And again, back to your point of
that's a great point. Yeah, fintech is really an interesting area. There's a lot of optimism in the bank sector, as you know, resulting from the election. It's probably appropriate. There's going to be less regulation, maybe some tax relief, and more kind of supportive people running the agencies. But there's also going to be likely less regulation of fintechs, and they're very tough competitors. The current administration has been pretty restrictive on fintech's ability to compete with banks and partner with banks and buy banks. And the sense is that going forward, the new administration may be a little more open to that. So we'll see. Fintechs are historically venture and private equity funded, so they are a little more financially sophisticated on average than credit unions. So who knows if they're going to be, as undisciplined, arguably, on pricing. However, the upside might be so high, particularly for smaller banks. You might see a fintech pay a good amount for a small bank because they're going to take it national. So we'll see, but I suspect there'll be a lot of activity, and no one knows what it's going to look like. Banking as a service, mortgage banking, Chime, who knows? But I think we're going to see a lot of that activity, and more buyers is good for sellers. Not great for other buyers, but good for sellers.
Yeah, and I think the two I was aware of is actually one was a national looking at a local bank, but they had a national charter. So that was a fintech looking to do that. And then the other one was exactly what you said. It was a mortgage operation looking to buy the bank operation. I don't remember. I know the first one went through. I don't remember if the second one ever did. So
the current, there's been some mortgage bank. We've done a few mortgage bankers buying banks, but the federal regulator has been very dubious about that and have watched very carefully. Of course, there's all kinds of cultural issues, but the feeling is the new administration, of course, they haven't even named their who the leadership's going to be, but the feeling is they'll probably be a little more open to that. So I think we may see those transactions. Good for the sellers. Are they going to be tougher competitors for the other banks? We'll see.
And then you had mentioned that one of the tailwinds was sort of the currency available. I don't want to say currency. The stock price is going up, and hence the amount of funds available.
Yeah,
I would assume that there'd be the other side of that, which is the value going up for the buyer, right, or the price going up for the buyer. Because if you're worth more as a larger bank, again, I probably have to make the assumption I'm a stock bank, right? But if I'm the value of all banks went up, theoretically, my board of directors should be saying, so did yours, right? In other words,
that's right.
The currency is worth a little bit more, but so is the price to buy the bank potentially. Is that enough of a headwind, or are some of these things are already kind of in the works, and therefore they haven't noticed that fact that there might be a potential price increase?
We'll be right back.
Is your technology spend getting a little out of hand? Are you worried about making those big strategic moves because of those hefty vendor contracts? Or maybe you just feel like your technology is currently holding you back. In today's banking world, overspending on technology is a risk you just can't take. Going up against those major vendors on your own can be tough, expensive, and especially when the contracts are designed to benefit them. That's where Remedy can come in. Remedy Consulting helps our clients stay competitive and grow their business with the right technology, products, and their spending strategies. Not a Remedy client yet? Head on over to remedyconsult.net for a free review of your tech stack, spending, and contract terms. Even if you're not the perfect fit, you'll walk away with expert advice and confidence in your technology decisions. Check us out at remedyconsult.net or give us a call at 262-955-7776. Thanks for tuning in. And now let's get back to the episode.
Right. So we'll break it down in a couple different ways. So from a seller standpoint, the urge to merge might be relieved a little because inflation's ameliorating, rates are down a little, there's a perception of a little less regulation. But by and large, there's still a lot of competition, a lot of IAT expense, et cetera. On the buy side, as you say, and I like the word currency, that's a good word. I think the currency is higher. I think the regulators are almost certainly going to be more open to acquisitions than they are now, which is good. We talked about purchase accounting and we talked about competition. So I think that there's always two sides to do a deal, but on the buy side, it's gotten significantly more attractive. So if they're more interested, then the sellers are going to get a better deal. And if there's a little less of an urge to merge on their side because their stock price is up, et cetera, they'll get a better deal because it's poker. So I think it'll result in more favorable prices, and we're seeing that already.
I think we hit most of the tailwinds that we want to talk about, right? These are the things driving more activity. When you think of the headwinds, is it just the fact that the tailwinds are falling off? Like every one of these things that we talked about is better for more merger activity? Or is there anything that you'd kind of say would be a headwind, something that might slow the activity down?
Well, the number of banks is going down. So it's kind of funny. If you look at the number of banks, mergers per year, if they're, around 125, that's actually a higher percentage of the remaining banks each year, if you think about it, because the denominator goes down. Banking is still hard. And there's a lot of uncertainty, political uncertainty, interest rate uncertainty, tariffs, all that stuff. Uncertainty is the enemy of transactions, and even change, even though it's good change, it's still tricky to advise companies on that. And you're very familiar. You're the go-to guy on the IT side, which is more difficult than ever, as you know. So I don't know if I'd call it headwinds. There's certainly fewer headwinds, but it's still difficult to do deals. If a fintech jumped in a deal today, how would you evaluate that? We don't know at this moment. We're still under the Biden administration. And even when the Trump people get in, we don't know exactly where they're going to stand, and they're at cross purposes. So we're in a new world. So I think that the investment bankers are going to have eat better steaks than skirt steaks. Not that skirt steaks aren't really good, but we'll see. But I think the banks that are not super progressive now and innovative now are going to continue to be under pressure. And then the guys that are a little bigger are going to continue to need to grow on the retail side, and it's hard to get customers. And the industry as a whole is not growing much on the deposit side. So the only way to get them is buy. So there'll be steady deals. Next year looks good, but is it going to be 200 transactions or is it going to be 150? Either case, it's going to be well above what it's been. And we just saw a large transaction a day ago. So there was Berkshire Hills and Brookline, and you'll probably see more of that. And then on the credit union side, there's a big appetite in that space. They probably will have to compete a little harder on price because a lot of the banks that have been sitting on the sideline are becoming more active. And we've been getting those calls, and that's all good if you're a seller.
On the buy side or the sell side?
Side.
Oh, okay.
Because their currency's up.
And they're saying, it's time to go
exactly.
Shopping.
Say the price in New York is 110% a book the last couple of years, sort of to use a marker. Well, now with purchase accounting, that same company, you can pay 100, in essence, 120. And if your currency is 30% higher, it's 30% above that. So they won't have to stretch in terms of the number of shares they issue as much. And that stretch is hard because it's dilutive to their own stockholders. And there's a crossover point called the earn back, which is super important to stock institutions. If you issue fewer shares, it's a shorter earn back. So for all those reasons, perception that the regulators will be more supportive, all those reasons, it should work out. And as you know, IT is a big factor too. And you're working with a lot of guys on that. If you're not set up properly, that can kill the deal right now or make it needlessly more difficult.
Yeah.
So Yeah, I think everyone's optimistic. We'll see. Another type of deal that we've seen a lot of in the last couple of years, unclear whether we'll see going forward, is investor transactions. Investors are a little bit of the last resort for a seller because they're harder to get approved, they take longer, and they're spending their own hard-earned cash, so they're less likely to give a big price and more likely to not be approved. There's been some activity now that higher quality buyers are coming back in. Will we see fewer of those? We'll see.
Right. So when you talk about an investor or a fintech, there must be some scrutiny around whether or not we deem you worthy to own the bank, right? I mean, back in 1905, you probably didn't have that scrutiny when, you and I would go to get together and get some capital and start a bank, right? But these days, I would assume with everything that's going on from international versus sort of internal within the U.S., I know a lot of scrutiny around, can fintech have a charter because of the risk of the fact that, their goal is grow, maybe even unfunded growth. What does that do to the depositors, right? Is there scrutiny on the investor side as well?
It's a lot. And it's similar to a new charter. And as you know, it takes a couple of years to charter a bank. Because if you come in, they say, okay, great. You understand banking. We appreciate that. Who's your CFO? Who's your chief lending guy? What are your lending policies, et cetera? If it's First National Bank down the street, they have all that. But they know you're a smart guy. And of course, you would say your first instinct is to say, well, once you give me the charter, I'll hire the chief lender, but I can't hire someone away now. So it's chicken and egg. They do the same thing in a sales transaction. However, if the franchise is not all that valuable, and a couple of years ago, the real value is in the charter itself, the investor will pay more for a charter than another bank. I mean, if it's just kind of a naked charter, just sitting there in the middle of Milwaukee, not a lot of customers, but it is a charter, those are the transactions that go with investors. But there's a lot of scrutiny. And again, there's we got the Doge agency or quasi agency and all that. What is that going to mean? Who's going to manage the agencies? It's a long road, and we get involved very early to try to meet with senior staff to try to get a roadmap. But if it were today, who knows? You go meet with which we just did. We met with some senior members of the FDIC board, which is great, but they're not going to be there on January 20th. You have to start somewhere.
Yeah, so you don't even know who to talk to for a little while here. Right?
Yeah, exactly. So, and even the new guys, they're not going to have a comprehensive, detailed strategy for a while. But you're right. There's change. It involves uncertainties, but under the current administration, there's been a lot of scrutiny, and some transactions have not gone through. And it's always easiest to go with two known entities. And if it's a First National Bank has been approved for 3 transactions over the last 7 years, and you're a seller, you could feel pretty good if their balance sheet looks good that they'll get approved for the 4th. That's not true for some investor or some credit union or fintech.
That makes a lot of sense. Anything else we didn't spend time around? I mean, I think we did a pretty good job with the positives and negatives of what'll drive the activity.
No, I think it's timely. The one thing I say to clients on both sides of transactions, it's plan, and model, because it's like building a house. You got to have the right foundation. So on the seller side, you model what you look like now and what you might look like in the coming years, and who potential partners might be, good partners to talk to, and you approach it in an organized way. Then partners, if you're the larger bank, First National Bank's buying for Second National, if you have a model already, you can integrate the acquisition into your model and understand what's the best way to structure it, how much you could pay, et cetera. And then the negotiators actually negotiate off those two models. And you say, no, actually, if you look at it this way, you should be able to pay another 75 cents, et cetera. If you're not prepared, if you don't have the framework and you're working against other parties that do, you're at a natural disadvantage, and it might be mispriced or wouldn't work out to begin with. So it's, start ahead, and you can't do too much preparation.
Yeah. And I think the unique thing about it probably is if you're a seller, it's the first time you've ever sold. Right. Otherwise, you don't
exactly
sold, right? If you're a buyer, there's probably a good chunk of the buyers out there, assuming it's not a regional that buys one every couple of weeks, right? There's probably a good chunk of the buyers that it might be a once in every 5-year transaction, or maybe even more than that. Maybe, once in a once in a lifetime. There's probably a group of acquirers out there that don't know what questions to ask, how to figure out even valuations, right? Even pre-merger, post-merger. I mean, there's a lot of moving parts there, and I would imagine that any one of these things is complicated.
Start early, and probably you're the first call. If you think you might want to do acquisitions as a bank, when you're looking at your IT infrastructure, talk to Charlie about what you need to think about to add on new banks. Same thing as a seller, obviously. If you are going to sign a new contract with Fiserv or whoever now, and you think you might sell any, so start early, and that investment will be repaid in spades.
Yeah, I would argue that just getting somebody that knows each of the pieces, because I mean, there's a couple of $1 million items in there. The tech side's clearly there's plenty you might not be planning for there, right? But I would think the same thing would be with valuation. With, does the board really want to get rid of this? How's the family going to handle the investment side of it? Meaning how are they going to take the taxes and all that piece? I mean, there's I can think off the top of my head 3 or 4 folks that, at least if they've done a few more of these than you have, it might make some sense to get those conversations going early, so you know what to think about, or how to get your board prep for it, for lack of a better word.
That's for sure.
Yeah.
That's for sure.
Well, Kip, thank you. I think we got everything I wanted to today, and I certainly appreciate it. Really good insight into just where things were for the last couple of years, and what this. It's not administration. There's a lot of moving parts here, but what these tailwinds do to this thing going forward.
It's going to be an interesting year. I think good year. But fasten your seatbelts.
Thanks for joining us on BankTalk.
Thanks, Charlie.
Okay, well, that's it for BankTalk. Everybody have a good day and keep on learning.
Thank you for listening to the BankTalk podcast, brought to you by Remedy Consulting. If you would like to reach out to Kip, you can learn more at looselaw.com. looselaw.com. That is LUSELAW.com. Thanks again, and we'll see you in the next episode.